What's going on, everybody? Good morning and welcome back to Beat the Bell presented by King Capital. Hope you guys have all had an awesome trading week thus far. Tons of volatility, some expected volatility late yesterday, but that's typically how things go during FOMC week. So again, hope you guys have been able to navigate properly. All right, let's get to today's panel. Starting with Money Mander. Money Mander, good morning.
Good morning. Happy Friday. Ton of volatility, as you mentioned, full 180 reversal on the daily candle there yesterday. So we'll see what we get today.
And nearly a full 180 reversal here in the pre-market. So right back pretty much to where we started. All right, diving trades.
Morning, team. Happy Friday. Like the guys talked about, pretty wild week so far. We've got a lot to cover. Excited to get into it.
And last but certainly not least, live from Dubai once again, Stock Snipa.
Good morning, guys. Let's get to it. Got some good questions for you guys today.
All right, let's get after it. Fed forecast and economic calendar. I mentioned it is FOMC week. What did we learn, boys?
Muted. Let's hit the economic calendar first, and then we will get to some developments from the Fed on Wednesday. So for today, we had core PCE that actually just came out at 8:30. Core PCE is the preferred measure of inflation for the Fed. So I'm actually just pulling that up right now. Core PCE came in at 0.2% growth month over month relative to 0.3% last month and 0.2 expectation. So basically in line there. PCE index year over year came in at 3% versus 3.8% last month and 3% expected. So basically in line for both the month over month and year over year readings there. And that drop obviously is going to be welcomed by the market. That's something that we saw with CPI. We saw inflation come down there as well. And so this is obviously a good sign. And the one thing that, we talked about when CPI had come in was that around this time last year was basically like when we saw a peak, some of the highest readings that we have ever had. And so when you're comparing the year over year numbers this month, it's going against really high comps from last year. So it's kind of expected to see that drop. And I think looking out into the future, the numbers will be a little bit more important as we'll have a little bit more regular comparables to compare the inflation with. But just something to keep in mind there. Yesterday, we also got some news on the GDP front. So yesterday, the Commerce Department released the GDP numbers for the second quarter, which came in at 2.4%, up from 2% in January and higher than the 1.8% economists were expecting. Both consumer spending, particularly in the discretionary and travel sectors, and higher than anticipated business investment were enough to stave off the economic slowdown that was anticipated by many economists to start sometime in the second half of 2023. Stocks ultimately closed red Thursday in volatile trading, as Alejandro mentioned, with the Dow, S&P, and NASDAQ falling 0.67, 0.64, and 0.55% respectively. Even though consumer spending came in at 1.6%, which is below the 4.2% from the first quarter, that still represented more than half of the gain in the total jump in GDP. Durable goods orders came in at 4.2% month over month against a 1% forecast and 2% in the previous month. Further evidence that the economy is still running relatively strong. And that's something that Jerome Powell touched on Wednesday in his press conference. So Wednesday, we had the FOMC meeting, and the Federal Open Market Committee raised their target for the federal funds rate by 25 basis points, bringing the target range to 5.25% to 5.5%, somewhere in that range. Fed Chair Jerome Powell said it was too early to tell if they're done raising rates, mentioning as usual it will depend on the economic data that they get between now and their next meeting on September 20th. Powell essentially left the chances for another rate hike at 50-50, which according to some is exactly what he was aiming to do, as this maximizes the Fed's flexibility down the road to react to the cumulative effects of their tightening campaign. Subhadra Rajappa, there we go, head of U.S. rates at Associate General, believes that whether or not we will get another rate hike or another 2 rate hikes of 25 basis points is more or less immaterial as long as it's within that range. The market is more or less priced that in. And so, whether it's going to be 1 more rate hike, no more rate hikes, 2 more rate hikes, the market is sort of prepared for all of those possibilities. And there will be, it's really just like a sort of fine tuning that final destination that they're aiming for, right? They're going to keep rates elevated up here for a long time. And so it would make sense to approach this ultimate terminal rate with a bit of caution. That's why they're going so slowly here towards the end, pausing last month, raising by 25 this month, giving it another 2 months before they decide what else to do. So they're pretty much crawling to the finish line here and just really fine tuning the monetary policy there. We've come a long way. Inflation repeatedly has proved stronger than we and other forecasters have expected, and at some point that may change. Powell said we have to be ready to follow the data, and given how far we've come, we can afford to be a little patient as well as resolute as we let this unfold. Powell also said the Fed's influential staff was no longer forecasting a recession to begin this year as they had in March, May, and June, and instead was projecting a, quote, noticeable slowdown in growth, which definitely represents a change of language that they've been using over the past several months. You've seen that word recession in some of their notes, and it seems that the committee is no longer predicting a recession for 2023, instead of a noticeable slowdown in growth. So that's one of the primary changes that I saw from the meeting. Mander, what did you come away with?
Yeah, I was looking at the press conference, and I think, at the surface level, his statement was very, very similar to what we get pretty much every single meeting, right? He goes over the policy they're implementing, and then, upside risks are still the risk of inflation. We don't want to unentrench expectations, XYZ. But I think actually when he went to answer questions, this was the first time I've seen Jerome Powell, really since the start of the hiking, seem rather optimistic in his diction. I think when he was answering questions for the very first time, he left it at a dead split 50-50, whether they hike, whether they don't. And I think that's good, just in case, as we talked about on Monday, I believe, if we do see inflation start to uptick with those lower year-over-year comps coming down, they're going to have to do something about it if we start to see a big spike back up into that 5% range. But I think for the first time, he was actually optimistic and kind of acknowledging how well this has gone according to plan. He was saying inflation's down now 6% from peak on the CPI print. He said core is finally getting down. Core PCE came down at 0.2 month over month, but we're finally getting that core CPI number back in the fours. He actually seemed rather optimistic and started to hint at, the things that were rather sticky holding inflation to the upside are finally starting to cool off. And so I think moving forward, we'll see if they get another 25 basis points. If they do, though, I think that's the max they do. And then the only forward guidance he really gave that kind of struck me as a little surprising is he openly stated they probably won't have a pivot or a cut on the table until the second half of next year. So I think that was the first real guidance he gave. They're looking at a whole year of a pause right now. We'll see if that actually comes to fruition. That is what he said in answering questions. I thought it was a rather great conference, though. And then coming right into Thursday with this hell of a week we had, GDP, massive surprise to the upside. So I was actually very shocked at the full 180 we had yesterday, whether it's just off the massive gap up we saw and, you had to see a liquidity grab to the downside. We'll see what we get today. It's really been the Wild West this week. The one thing I really wanted to cover on top of everything we've had going on this week is the race to the AI dominance that we had. And we really saw numbers in between Microsoft and Google when they both reported on Tuesday. I think it was rather fitting they both reported on the same day. And coming right at the very forefront of this call to generative AI, these two companies in particular, is seemingly coming at an expensive cost. And so while both companies reported top and bottom beats, we saw Meta with a massive beat as well. I think the numbers are reflective of the GDP beat that we saw. These companies are bringing in better than expected margins and revenues. But Microsoft's next quarter projections were below estimates, obviously represented in down 6%. And let's take a look at the CapEx numbers here. Google's CapEx this past quarter came in over $1 billion below estimates versus Microsoft's, which jumped 30% year over year to 8.9%. So while Google beat on CapEx expectations to the downside, which is rather good, Microsoft actually beat to the upside. And the investment into AI really began to tally up here. The CFO said they're projecting to sequentially increase this from 8.9 billion every single quarter through the next fiscal year. So that was really the reaction between Google and Microsoft, the difference there while they both beat on surface levels. But to put this into perspective here, Google posted 71 billion in free cash flow. Microsoft posted 60 billion in free cash flow. Both showed 28 billion in CapEx over the last 4 quarters, which is more than 75% of the S&P 500 companies' revenue for a whole year. So they spent more in CapEx over the past year than 75% of the S&P 500 makes in a total year. So this is clearly an expensive race here. And I think it's kind of struggling to those smaller companies that can't afford to get in this, right? The majority, 99% of companies can't afford to put $28 billion into a calendar year in investment. And so I think that's really reflective in the stock price we've seen. And that's why these companies, while everyone was saying, the mega 7 is the one that's rallying because they're the safe stocks, I think it's more so as we get into this AI bubble, until technology becomes to get cheaper, they're the only ones that can afford the investment into this right now. And that's obviously reflective by their market share in the space and their stock price over the past 6 months. But this will be interesting. I think we're really moving into one of the biggest emerging markets in the past 2 decades. And so we'll see how this massive investment they're putting in pans out in terms of profits over the next year. That's going to be the big thing investors are watching.
A couple of things. First on Google, I'll start there. I think when you look at the sort of AI race like you were talking about, it feels reminiscent, and we've had the pleasure of having some experienced folks to talk about this with. It seems reminiscent of the dot-com bubble, in the sense that there are going to be, like you said, those larger players who can afford to make sizable investments in the space that will likely lead the charge, and then a lot of those middleman, middle of the pack companies that you see sort of popping up, the generative AI and language learning models, a lot of those companies are going to zero. And then you'll have on the other end of the spectrum some of the smaller, more specialized players in the space that will get either bought out or be able to carve out their own little piece of the market. It's really going to be like a barbell effect, right? Where most of these companies, most of these AI companies are going to pop up, and there will be tons of them over the next several months as people attempt to take advantage of this opportunity. Most of those are just going to get blown out of the water, right? Because like you said, they just don't have the capital to keep up with the investments in the space, like the Googles, like the Microsofts. And so I think that's probably what you'll see there, is that you'll have a few players really dominating, really benefiting from AI on the top end, and then a lot of those middle of the pack companies will just sort of cease to exist. And then you'll have on the other end of the spectrum some smaller players who are able to really find their niche. I feel like that's the most likely outcome there. And then secondly, on the Fed front, you did mention how Powell talked about they're not expecting to cut rates until the middle of next year, which was sort of a change, or at least not even looking at it. I mean, it's crazy because he admitted that they're not really expecting to see inflation down to 2% until 2025, right? So he's already come out and said that. And so if that's the position that the Fed is holding, and for reasons like we talked about, the comps are going to get more tough, and it's going to be tougher when you don't have favorable comparables like we do right now to really continue to bring inflation down, right? It makes sense that they really wouldn't want to even consider to cut rates for at least several months, and it seems like it just keeps getting pushed further and further back as we get into this sort of soft landing narrative. He seemed, like you said, a bit optimistic. I thought he seemed a bit surprised that things are going so well. And if you're in his position and you've been able to hike rates so much, so aggressively over the past year, and nothing has really broken, what's the incentive to bring them back down, right? If things are fine, you might as well keep them up here. There's and sort of wait and see. It seems like that's sort of their game is just keep rates as high as they can for as long as they can, as long as nothing breaks. I just don't understand what the incentive would be for them to even want to bring rates back down, right? Everyone keeps talking about that eventual pivot, but if raising rates this much hasn't affected unemployment, it hasn't really broken anything in the system, and they can continue to do their quantitative tightening, and things are sort of that Goldilocks scenario where inflation is coming down, unemployment remains relatively unchanged. What's the incentive for them to want to move rates lower? It just doesn't seem to make sense to me. So maybe we'll have this new regime of elevated rates for quite a while, right? Until they're really incentivized to do something different, which doesn't seem like they are, at least not at the moment.
Yeah, I think that's more likely than not, especially looking back. If you go to the 2000 rate hike, if you go to 08, 09, 07, that whole era right there, really the only reason we got those massive cuts was because something broke. And it was a very hard landing. We got sent into recession and they had to. But right now, I think what Powell is saying is probably more likely than not. If we have this resilient economy that we're seeing, if we're 550 basis points off of hikes that we've seen over the past, call it 18 months, 16 months, and unemployment rate is still at historic lows, GDP is still beating to the upside on a 2.4% increase on a quarterly basis. I mean, what incentive would they have to cut? They wouldn't. And so until inflation either gets to 2% or something breaks, they're going to keep rates where they're at. And so I think really where we're seeing with the resilience of the economy, it's likely it takes a prolonged period of pausing out into 2024 and then still kind of elevated. Whether we get any cuts at all, it's going to be minimal, maybe like a 25 into 2025. That's really what we're going to see, probably a prolonged period of elevated rates with a slower but still growing economy here, which really would denote your soft landing.
Yeah, agreed. All right, that'll wrap it up for us here at Fed Forecast. Pass it back to Alejandro.
Awesome. Thank you, fellas. Going to go over to Stock Snipa now for Bet the Bell.
Good morning, guys. I'm going to start it off with our typical first question. Green or red today in the market? What do you guys think? I'm going to start this one off with Hondo.
Can we get a look at the stats first? Because I think we have an important development.
Oh, we got
an important milestone. 50 wins for Diamond and I.
Wow.
Well done, Noah. Still right up your ass, but should be changing soon. All right, we can continue now.
Congratulations to Diamond and Noah, or Diamond and Hondo for 50 wins. It's a pretty big accomplishment. Wow. Yeah, I'm going to start it off with Hondo. Green or red today in the market? What you got?
I'm going green.
Okay, I like that. Diamond, what you got?
I'm gonna go green as well. Yesterday's close was definitely a bit scary, like Mander was talking about. Running up here in pre-market, but I'm gonna go green.
Mander, what you got?
I got to take green as well, and not even as a hedge with this. I think after the 300-point reversal we saw on the NASDAQ, for us to be up 1% again, I don't think we get a gap up and reversal back to red 2 days in a row. So I'm going to take green.
Yeah, after yesterday's pullback, I'm going to have to agree with you, and I'm going to have to make it green across the board.
And
I'm going to dive into our next question.
Goodness.
There we go. See you guys at 4,500.
Nah, chill with that, man. Chill with that. I think we all get a dub today. But I'm going to go ahead and dive into our next question, something pretty interesting that I was reading about on Twitter. We can notice that lots of AI technologies are coming out, and OpenAI CEO Sam Altman has said that because of AI, some jobs are definitely going to go away. Now, my question for you guys is, which jobs are the most threatened by AI? I'm going to have to start this one off with Money Mander.
I think the easy answer would say administrative jobs, really anything that does not take intellectual capacity. But really looking forward, I think if you look at accountants per se, right, how easy would a job of an accountant be to replace with AI? When all you do is submit all of your, everything's already online, right? These companies are already doing everything online with revenues, with expenses, with sales. How easy would that be just to replace an accountant and have everything get crunched with an AI bot? I think those kind of jobs really, I think moving into a more professional space, anything that doesn't take physical skills coupled with your brain. So if you look at a doctor, if you look at a lawyer who has to present to the jury, you obviously can't replace those. But I think a lot of these professional space jobs, if you're sitting at a desk and you're using your brain, but you're working on a computer, obviously us as discretionary traders, you can't really replace that. But I think a lot of, obviously traders have already been replaced by quants and with algorithms in the stock market. I would look for that to move outside of that space to accountants, to what's another one you could say? Consultants,
bank analysts.
Say again?
Bank analysts. So I think that some of the jobs that are going to suffer are those like first and second year Wall Street jobs, where really people are working as Excel monkeys for their first few years on the street. And another one would be customer service representatives. How much easier would it just be, you're speaking to an AI bot who has all the answers for you, whereas most of if you call a customer service representative, it's kind of a uniform process for how they go through and answer your questions. I think that that's a job that can be easily replaceable.
Yeah. Diamond, what you got?
I would kind of the same route Alejandro went, like back office jobs where it's like a lot of data collection and like data submission and things like that. Like busy work almost, it seems like, right? So I feel like those jobs would sort of probably be better done by AI, more efficiently done. You wouldn't have to pay somebody to do it. Yeah, I would say jobs like that where you're not necessarily like super customer facing, the back office stuff probably at risk. So yeah.
Here's a high paying one that we could think about. What about investment bankers? If you're a Fortune 500 CEO and you want to acquire another company, right? You either pay Citibank to pay their investment bankers $500,000 a year, or you just ask AI in the future, like, what is the easiest way for me to acquire this company? Is it hostile takeover? Is it leverage buyout? Blah, blah, blah. I think that whole space could get taken out.
Yeah.
One thing that
I could see that.
I could see it, but I do think that like a lot of those like client-facing roles are important because they are client-facing, and the human relationships are extremely important when it comes to deal making, which would be the only reason I would kind of have pushback on that. But as far as the actual tasks that are being completed, absolutely, I think it could be replaced by AI.
Yeah, like the diligence part of the deal, I would understand, like for sure. But yeah, like Alejandro said, like if I want to acquire a company, if I'm Amazon and I want to acquire like my 1,500th company, right? Like I'm going to go to JP Morgan or Goldman Sachs, not necessarily because they have the best mathematicians on earth who know how to add numbers and value a company, but because they have experience in certain sectors and they have, it's that experience that you're paying for, right? It's the fact that they've done multiple deals in the space. They know what they're doing and that sort of thing. Like I understand that AI can definitely probably do some of the diligence factors of, really trying to model out what a company is worth today and will be worth at some point in the future. But I don't think that you can really like jump over that experience factor. I think that's an important part of the process.
One job that you guys haven't mentioned, content creators. I'm sure that you guys have seen a couple Instagram reels or videos that are completely created by AI, which someone just types a couple things into the AI system. I mean, I believe it's not OpenAI. It's a different AI that's doing that, but they just type a couple things into there and it creates an entire video for them, which I think content creators might be in trouble too.
I actually think that would make original content even more valuable then, because what's the differentiator? If everybody's making AI commercials or whatever, like what's the differentiator there? Like, I'm sure that you can use AI to help spice up your content, but I think if we get to that point, like you're saying, original content is going to be even more valuable at that point. No, like or at least that's what I would think.
Yeah, it sounds like original content might become more of a luxury. So maybe content creators, make more money and there's few of them. Yeah, it's something interesting to think about for sure.
Yeah. So I'm going to ask the $1 million question of the day. SPY, right now, do you think by the end of this Friday or today at close, over or under 452.5? I'm going to have to start this one off with Hondo.
This is going to be over. So we're trading at 455 right now. We're reclaiming key levels into the pre-market to start the day. And so I think that we are going to trade over that 452.5. We'd have to sell off about 30 points and take out yesterday's low. And I don't see that happening. So
in my opinion,
the green guess from earlier too.
I mean, in my defense, at the time when this question was formed, SPY was sitting at 453.33. But whatever. Mander, what you got? Over or under 452.5?
You can't shit a shitter, and we closed at 452.50 yesterday, so you basically just asked me green or red twice, and I'm going to stick with it. I'm taking the over.
Yeah, this question should have been adjusted.
Yeah.
Maybe we can replace you, Snipes, with AI.
Oh, chill, dude. Okay, Diamond, what you got? I mean, I'm pretty sure I know what you're going to say.
Over.
Yeah, I'm going to have to smash the over as well. I think there's very low chance we go under 452.5. But again, this question was formed when SPY was sitting at 453.33 and did lack some adjustment. But that'll wrap it up for Bet the Bell today. I'm going to pass it back to Hondo here.
All right, awesome stuff. We're now going to go over to Money Mander, who has Market Moron for us this morning.
been a while. Let's read through this. We found this off of the Wall Street Bets Reddit, and I want to get the guys' take on this. So here's an input. Just sold all my VOO, which is Vanguard's S&P 500 fund, and QQQ to put 90% into TLT long bond ETF and 10% into Bitcoin. Am I dumb? Just thinking market corrections coming. Greed levels very high. Earnings reports haven't been the best across the board. I don't know what earnings he's looking at. I think rates are eventually going to drop, so TLT will then go up. Bitcoin's a small gamble, but I see it as a decent long-term investment. What do you guys think about this? Basically trying to hedge his longs in an S&P 500 and tech ETF, which really is a pretty safe long in all bets. And saying that with yields coming down, even though the Fed just said they're going to hold them there for the next year, he's expecting bond prices to go up and Bitcoin as a speculative investment. We started with Diamond.
I just don't know how much sense that makes. I mean, with where rates are and where rates are projected to go. I mean, if you think that, like, what would have to happen for the Fed to aggressively cut rates? Like, I'm trying to think of something that would make, like, it would have to be like a black swan type of event, and in which case, like, why wouldn't you just like buy? Well, I guess I understand why you wouldn't just buy leaves, because they would expire, but I don't know. I disagree with it, but I actually don't think it's like the worst thesis in the world if you think that that's going to happen. I just don't think it's going to happen. So I don't know. It's definitely a gamble. Hope that guy. Hope Bitcoin goes to 100K for that guy. Rooting for him.
Hondo.
Mander, can we see it one more time?
Yeah, they're back up there.
Sold all my VOO and QQQ to put 90% in TLT and 10% in Bitcoin.
This is basically just somebody who's trying to be a hero. And this is the same type of person that's gotten punished for the past 8 months since the market has rallied off of the October lows.
It sounds like he was in the long.
What?
It sounds like he was in the long this whole time.
No? Right. Yeah. But to my point, people who try to avoid market volatility always seem to get in trouble. If you're trying to outsmart the market volatility, you've probably had your head up your ass for the past 6 months and just watching this thing rip face, and you haven't taken part in the action. And the only reason that could possibly be the case, anybody at this point who's, questioning whether or not they should be long or whatnot is probably because they missed the move. Now, this is the other side of it where you've been long and now you're questioning, can it go even higher? I don't know this individual's, plan, if this is a trade, if this is a long-term investing, whatever he's doing, but to take all of your money out of the S&P 500 to me doesn't make any sense. And that was proven through last year. Again, market volatility is the price you have to pay to be invested. The market promises you about 8% every year over the course of multiple decades where you could just sit back and compound your money, but that's not enough for some people. They try to get really cute. They try to avoid that volatility, and then it doesn't, typically ever work out, like literally ever. So it's best to just hold on to that VOO and that QQQ, in my opinion.
It's nice.
Yeah, so like, I'm not gonna hate on someone for taking some or buying some shares of VOO or buying some Bitcoin, but by the way this is worded, it seems like this is a majority, if not all, of his personal wealth. I think that he should sell 1% at least in VOO or BTC and buy a bunch of tissues for when he sees his stuff tank. But again, I can't hate someone for wanting to trade, but as far as investment-wise, I think that this is a big L.
Yeah, I'm going to agree. I think there's a reason that money managers stay net long probably 95% of the time, and it's that you always want diversification but exposure to equities. And so to sell everything and just go solely long bonds and then a little bit of Bitcoin, that makes no sense to me. If you're trying to avoid, risk in the stock market, thinking you need to take profits, why would you take it out of the S&P 500 and then put 10% into Bitcoin?
Let's get this guy on the show.
Let's
get this guy on the show.
Yeah, we should get him on the show. We'll find him. That'll wrap us up here, though.
All right, guys, that's going to do it for this morning's episode of this week of Beat the Bell. Thank you guys for tuning in. We'll be trading live all day in the Kane Capital Discord. You can go to kane-capital.com or scan the QR on the code. It is Friday. Trade smart. Don't lose your ass. And we will see you guys back here on Monday morning at 8:30 a.m. Eastern Time. Have a phenomenal weekend, everybody.